later today.
Andrew Green in Canberra, many thanks.
Thanks, Ade.
The US debt deal might be across the line, but global markets have fallen heavily on deepening concerns about America's economic woes. Wall Street has closed more than 2% weaker in the longest losing streak since September 2008. The catalyst was an unexpected fall in US consumer spending, which has raised new fears about another recession. For more, we're joined now from Sydney by the ABC's business editor, Peter Ryan. Peter, good morning. Global markets obviously have certainly gone down. Do we put it all down to this cautious US consumer?
Well, good morning, Francis. We've been hearing a lot about the cautious consumer here in Australia, but in America, it's really serious. Figures for the month of June has shown that consumer spending is down by 0.2%, which really shows how fragile consumer sentiment is there, particularly when you look at household incomes are also flat for the month of June. And we also have unemployment of 9.2% and no sign of that abating. So consumers in the United States are very concerned about keeping their jobs. And this ties in with the whole demand for products. And we've also seen just yesterday that manufacturing has taken a hit as well, down the lowest in 2 years. So if you look at that in the context of the damage that the debt ceiling debacle debate has done in the United States at home, things are getting pretty bad.
So what does the US Federal Reserve do to address this situation? It's got what appears to be a sliding economy, and its efforts so far haven't seemed to have done a hell of a lot.
Yeah, that's right. Well, the US Federal Reserve has kept interest rates close to zero for more than 3 years. They've been through 2 rounds of quantitative easing. That's the metaphorical printing of money, repurchasing assets to encourage lending between financial institutions. But the Federal Reserve will be watching what's happened on Wall Street very closely when you take into account the S&P 500 down 2.5%, the Dow Jones Industrial Average down 2.1%, and what they have to do to try to kickstart this very weak and flatlining economy. And talk has started of quantitative easing Mark III to prevent what could be a fresh recession in the United States.
Now, a lot of this negativity is to do with America's AAA credit rating. We saw this morning that Moody's confirmed that rating, but is there still a possibility of a downgrade?
Well, that's right. Fitch came out this morning and said that they would reaffirm America's AAA credit rating, but as long as they saw spending cuts over the next few years, or strategies for more spending cuts. But the big concern, Francis, is that Standard & Poor's came out over a week ago and said that unless they saw $4 trillion worth of spending cuts, that they would seriously consider downgrading the US from that rolled gold AAA to AA+. And these concerns is what's behind a lot of the weaker sentiment that we've seen around the world, with the All Ordinaries in Australia down 1.3% yesterday, big falls across Europe overnight, and today is going to be pretty ugly in Australia. It's looking as though the Australian market's going to be opening 76 points, or around about 1.7% weaker. So we're in for a very, very volatile period.
Just staying in Australia there, Peter, locally interest rates were obviously kept on hold yesterday. It was clearly a finely balanced decision for the Reserve Bank Board.
Yes, and it was a very interesting statement as well, Francis. And I've been saying on this program that over recent years the Reserve Bank has become more direct in its language. And in the statement that came with that decision to keep rates on hold, the Reserve Bank said that they actually did consider raising interest rates yesterday. And yes, it was finely balanced, but in the end they judged that it would be, quote, prudent to stay on the sidelines because of what we've been seeing in the United States and also Europe, and also the continuing uncertainties globally. And the big question now is, are we on hold for some time, maybe just a few months, or as 1 or 2 economists have been saying, could a rate cut be the next move?
Well, yes, as you say, I mean, the Reserve Bank Board saying it wants to stay on the sidelines at the moment, but that won't happen forever. You mentioned the possibility of a rate cut there, but isn't there a view more generally that interest rates will eventually have to rise?
Yes, look, the view is that the Reserve Bank made it very clear in the statement yesterday that they are totally on inflation watch, which is, after all, their mandate to keep inflation in between the comfort zone of 2 to 3% over time. Many economists believe that rates could be on hold for a few months. Some economists have said that November is looking like a likely spot when rates could move. There's a long time between now and November, a lot of uncertainty in the world, and also some uncertainty, of course, in the non-mining sectors of the Australian economy. Westpac, which came out and predicted a rate cut by the end of the year, has maintained that view, and that view is that by the fourth quarter of next year, the cash rate will be 1 percentage point lower at 3.75%. So they're standing by that, but there's a fair bit of water to go under the bridge before we see that come to pass.
We'll watch it with interest. Peter Ryan, thank you very much.
Thanks, Francis.
That's the ABC's business editor, Peter Ryan there.